Okay, so our first speaker is Allison Macfarlane, and she's the lovely lady who's filling in for Michael Blake. By the way, is this the modern age problem of middle-aged men? He's gone to America and has hurt himself in a motorbike accident, turning right when he should have turned left. And my question was, was his wife with him? And his friend said, no, it was a boys' trip. So you can imagine the level of intelligent activities that you get in a boys' bike trip. And so such a valuable resource to Centuria is now sitting up. I might have to go over and chuck on him again, I think, just to get even with him. Allison, please come to the stage.
Thanks, Peter.
Thank you.
Well, good afternoon, everybody. You might recall I filled in for another colleague last year, so it's my great pleasure to be back here and talking to you again. Same topic, but what's different this year is we've got a new product called Life Goals, and I'm here to launch that concept for you this afternoon. Investing to achieve your life goals. Most of superannuation focuses on planning for your retirement, and for many it's a very long way away. And for some of you in the room, it's not so far away, you're experiencing it. But for many investors, there's other things happening during their lifetime that they need to save for, be it sending their children to school, saving up for a home, passing their assets on to family members upon their death. So the whole life cycle of goals that one might have. So we've spent some time at Centuria refocusing our efforts in this sort of background of changes to superannuation that's making the investment bond structure popular again. So I will be, in this presentation, introducing you to some of the concepts of the investment bonds compared to other tax structures, looking at who is suitable or eligible to invest, and then walking you through how we've selected the underlying managers that are options in those funds. So this is the most technical slide you'll see in my presentation, so please don't get frightened off by it. What it shows are the four options you have when you're investing, say, $10,000 in the market, and you might invest in shares or managed funds, but you'll be investing either in one of these four options, be it your personal name, and for the highest marginal rate of tax, that is 47%. Superannuation, which by a long shot is the best or lowest tax at 15%. However, as we know, since July 17, there have been limits on how much you can get into superannuation and the limits on the balances that you can hold. And also, it's just not accessible beyond 65 for most people. So what else do you have? The family trusts and company structures, where earnings are still to be distributed at the marginal rate of the investor or the person that's the beneficiary. So it doesn't really help too much because ultimately those earnings must be distributed. And the company structure, of course, is 30% at the moment. And in this changed environment that we're talking about with prospective new government, they're proposing for trusts to be the minimum tax level to be 30%. So the governments in previous times have closed the loopholes for getting money out to children, and now will close, if the Labor Party are in government, close that last loophole, which is being passed on to a spouse or a young adult that's on the lowest marginal rate and getting money out tax-free. So we're really stuck, in other words, for other options, which is where Life Goals comes in, of course. So the maximum tax on earnings is 30%, but like any of the other three structures, franking credits, property depreciation allowance, and other deductibles can make the effective tax rate lower. There are no distributions, so think that one through. Family trusts can actually invest in bonds and have no income to distribute. And after 10 years, the tax, the withdrawal can be made at no tax to pay. So in other words, no capital gains tax if you hold the investment for more than 10 years. You can, of course, access your capital before 10 years. It just means you pay back the difference between your marginal and the rate of the 30%. Trying to make this simple, so bear with me. One last point. Beneficiary nominations means that you can nominate someone to inherit your bond or your investment after you pass away outside of your will. So there's no probate to wait for. There's no everyone sitting around the table listening to who's inheriting what after your death. So we'll go into a couple of these case studies a little later on in the presentation. Again, this is a busy slide, but it's really to make a point that when you compare investment bonds and superannuation over time, there was a fair bit of development earlier for investment bonds. So the friendly societies were established in Australia in the late 1800s to provide for the poor in society. And they developed to then release the first investment bond, or insurance bonds, as they were known, in the 1970s and 80s. And then the last major change was back in 2001, when the tax rate, the company tax rate dropped to 30% and the bond rate dropped in line with it. So pretty static regulatory change there. Compare that to superannuation, however. So super only became known or used widely in Australia in 1992 with the superannuation guarantee. And of course, since then, we've had a fair bit of tinkering, haven't we? It's been very complex, it's been hard to keep up with. Major changes in 2007, major changes to 2017. So I won't go through all of that, but there has been some uncertainty, and we now have a system that is fine, but it's not the be-all and end-all that it certainly used to be, particularly if you can't get as much, any further funds into a tax, either free if you're in pension phase or only 15%. So who should invest in life goals? We've identified 5 different investor profiles, and you might recognise some of these for your friends, family, or yourself. So goals-based investors, typically, they're younger people that are saving for a home or saving for when they send children to school. They want a tax-effective environment to have that regular, disciplined savings. And then they want to withdraw that, certainly before retirement. So that's the first category. And they may be your children or grandchildren. Then those that want early retirement. You might be familiar, but the Australian Bureau of Statistics says that the average Australian wishes to retire at 55. Yet we can't access our superannuation until we're 65. So there's a bit of a gap there, isn't there? It's very much, a lot more people are pushed out into either working longer, or those that are coming up to that sort of point in time and thinking, what can I do in the next 10 years to give me an income stream when I retire? And I'll show you a case study about that a little later on. High net wealth investors, they can be of any age, of course, typically people that are on the highest marginal tax rate, and they're having issues getting any further funds into superannuation following the caps on super balances. So they're looking for alternatives. Another one is if perhaps they're single and they're widowed or widows, that when they pass away, don't realise that there's a hidden death tax on their super balance. So lump sum death benefits to non-financial dependents are taxed at 15% if already taxed, or 30% if untaxed before. So that's something that a lot of people are not aware of. And so they're looking for a vehicle that they can put a lump sum of money that they don't necessarily need to live off themselves, that they want to live in a growth environment for the next generation. And by the way, investments in a bond structure can actually be transferred with no tax to another person, and they don't have to be related, but they can be switched from investment options or to different entities at no tax. So that's another handy one. Companies and trust structures, of course, have their place, and we're not saying that you would have one over the other, but they can be costly, they can be complicated to run, and certainly if the Labor government has their way, they may not be that tax effective after all, if they bring in that 30% minimum. tax. Complicated families. Who doesn't have a complicated family? Well, with the high divorce rate, I heard a stat the other day that 70% of second marriages end in divorce. Amazing. So there are a lot of people out there that are trying to protect either their children or somebody else's children from inheriting money. There might be a gold digger happening over there in the other side of the family. Investment bonds or life goals could be useful for people to set up a nominated beneficiary, and it pays outside of the will. So very interesting. Of course, seek estate planning advice from your practitioner, but that can be a simple solution for investments outside of your will. And finally, children and grandchildren. We're seeing, these days a lot of grandparents love their grandchildren more than their own children. And the number of cases that I deal with, financial planners mostly, saying they want help with structuring these investments. So it's certainly well worth considering. So let's have a look at a couple of these case studies. For the young investors, so say at the age of 25, they have $500 to start. So it's very small minimums to access life goals. And if you wanted to be a very generous parent or grandparent, you could perhaps give them a bit of a start, but just being cheeky there. For $500, they could start themselves and invest $500 a month for the first year. And then this structure does have up to 125% increase of the investments as long as they're contributing every single year. So we've mapped that out over the next 15 years. We've assumed a total return after tax of 3%. So I think we've been fairly conservative. The equivalent on a 35% tax rate would be a 4.6% return. And if on the highest marginal, the 47% tax rate, the return would have to be 5.6%. So we're being fairly conservative over the 15-year time frame here. So you can see the amount of total contributions, the amount of earnings after tax. And so that $317,000 is now available to be withdrawn when they're 40. They've got a family now. They have school fees to pay, and off they go. So you can see certainly the benefits of compounding interest, the old tried and tested compounding returns there coming through in the latter years. The second one, early retirement. This is, say, a 45-year-old deciding that they want to retire at 55, and they're going to start saving straight away, and then when they turn 55, they're going to draw down an income stream. And again, similar assumptions as before, that'll provide them with $25,000 a year for the next 10 years. Not too bad. So looking at how do we select the investment options within life goals, there's 10,000 different managed funds out there. So we are aiming to produce a very tight but diverse list of complementary funds that are either active or index funds, depending on what the client is wanting. And our investment team goes out and selects those options. We also use, through our investment committee, Lonsec and Zenith Research, and we conduct both quantitative and qualitative screens on these portfolios, and keep up with that every single month just to test. So you can see that we're putting this through a lot of rigor. Most investors just focus on returns. We're looking at the risk-adjusted returns as well, which is really important, particularly when you're looking at the long 10-year time frame and beyond. And you don't want to end up with a fund that's that you invest in that then goes out of favour, drops the ball, the whole investment management team leaves. So we're actively helping and assisting the investor do that in our investment process. So here are some of the managers, or these are the managers in our new life goals. I believe you've heard from Magellan today. Some of these other names are worldwide names, such as Vanguard and Schroders as well. Fidelity is also here. Our stand is next to Fidelity's. So it's all about offering choice now. In the old version of this product, we had only growth and managed options. This way, you can come in and invest, select your own managers. So here are the different investment options per fund. per asset class, diversified and balanced Australian shares, international shares, and property infrastructure. So plenty of information there. If you want more information on that, please come and see us. We have some booklets on our stand. We have lots of information on our website as well. So we really look forward to talking with you if you're interested in discovering life goals any closer. So in wrapping up, we are offering you a tax-effective vehicle of investing with a tightly constructed investment menu to give you control. You can switch between those options at no tax. You can stay in that tax structure and withdraw after 10 years without paying any capital gains tax. And there's no tax returns to complete, no fiddling around. So it's a very simple online application process. Centuria, you've heard from us earlier in the day, is listed on the ASX. We have a 38-year heritage in investment bonds, and we have dedicated people to help support you. So thanks so much for your attention today. I look forward to talking with you, and this is just a disclaimer to highlight that this information has just been in general in nature, and for specific advice, we encourage you to seek specific advice. Thank you.